Hi, this is James Eng with Full Capital, and today in the August 2023 multifamily financing webinar, the question is now the time? And it's a question that I've been getting the past month, 2 months, 3 months. Is now the time to go? And so we're going to get into that this month. And the past couple of months I've been off. The kids have been off for summer, and so we spent some time over in Hawaii. And one of the things that people love to do in Hawaii is surf. And so it's been one of those things that I've been wanting to do. And so I signed up for a lesson. And when they teach you how to sort of get up on the board, but they don't really teach you much anything else during the lesson. And a lot of surfing is about timing, right? So when you first start surfing, you sort of lean back because you don't want to fall over. And that's how you start off at the beginning. And then you move into leaning forward a little bit too much, and then you fall forward the other way. And then eventually, after a couple hours, you're up on the board. And so that's my glimmer of hope for all you multifamily investors out there, is that through this cycle and through this timing, there's definitely going to be some rough waves coming up ahead of you. But enjoy the wave and learn how to surf it and be up on 2 feet. And so that's what we're going to be going through today, is what the market is seeing in terms of opportunities out there, and being able to sort of ride these rough waves home. So, all right. So here's the agenda for today. We're going to go through really sort of what we're seeing on the market in terms of brokers, in terms of new deals, in terms of pricing. And then we're going to talk about actual public companies, what they're seeing from the lending side, ownership side, broker side, and then a couple of private companies. And then also get into financing and how people are putting these deals together. So, all right, let's just jump in here. So this is a snapshot of my inbox just from the last couple of days. And you can see that the deals are coming, right? So this is really Dallas, Austin, San Antonio, even Houston, and the number of deals each day. This is Monday, Tuesday. I could have snapshotted Wednesday and Thursday, but 10 plus deals a day that are coming on the market in terms of listed, touring, all these things. And if you go back a couple of months ago, there really was maybe one deal a week. Like there really wasn't much in terms of deals that were coming on the market in terms of being listed. And so the velocity of deals is coming. All right. So that's good. But how are these deals being put together? Right. So let's really start. A lot of these deals are loan assumptions, right? So Fannie, Freddie, HUD, all those types of deals are assumable. And a lot of those interest rates that were done in the last 3, 4, 5 years are anywhere from 2%, 3% interest rates, all the way up to maybe 5%. And so all those are better than what you got right now. And so a lot of those loans have positive leverage. So you can buy it at a 5 cap, get a 3% interest rate. So you have positive leverage going into the deal. But the other piece of it is the pricing is getting reset on a lot of these deals. And so here's an example. I couldn't give you the name of the property, but it's 300 plus units in DFW, 1980s construction. And the seller bought it in November of 2021. They had a 2-year bridge loan for 35.7 million. And it is currently under contract for 35 million. So this is the first that I've seen, and there's more to come across the board in terms of deals that someone is buying for under the loan amount or at the loan amount. And so the equity essentially on this deal, if you bought it in 2021, is gone, right? So they maybe paid 42, 43, 44 million. I'm not sure the exact purchase price in 2021, but now they are selling for under the loan amount, and potentially will have to bring money to the table to just close this deal out, right? So you have to bring that additional capital just to close this deal out to avoid foreclosure. And so I think we're going to start seeing, since I started in 2015, there's been this steady march of higher loan amount, higher sales price, higher loan amount, higher sales price on, every couple of years, these deals were selling. And so now we're going to see a reset in pricing, and this is coming, and it's coming for sellers that are distressed. So in this case, the person might have had an interest rate cap, but the maturity just caught up to them. So they just didn't have enough runway, and the timing is getting to them, right? So the whole time it was things were going well, cap rates kept going down, interest rate kept going down, and people were buying these deals and could sell them for a higher price a couple of years later. Now you sort of got caught in this cycle where the maturity just didn't give you enough runway on this deal. So here's another deal, 288 units in Arlington. The seller bought it about 2021, same time frame, right? So back half of 21. They did a 3-year loan, which is good, but then the interest rate cap was only, the maturity is 3 years, but they might have an interest rate cap. They might have some other problems in their other portfolio that they need to take care of. So they're going to market now. And the whisper price on this deal is $36 million, which is about 4 or 5 million over the loan amount. And they purchased the property probably closer to the high 30s. So they're going to probably lose about half their equity on this deal. And this is a listed deal. And they have a lot of bad debt on the property. The occupancy is okay. It could qualify for Fannie Freddie, but the bad debt vacancy, it's not going to qualify for much. So they just could not refi out of this deal. So it's going to be sold for just above the loan amount or a little bit above the loan amount. But here in the bottom right, I just highlighted some of the deals in DFW where the loans are coming due this year, right? And so some of the lenders on the right-hand side, these were all bridge loans, right? So this loan duration was anywhere from 1 to 3. And these are the lenders and these are the loan amounts. And so if you are in a market and you're looking for opportunity, this is where the opportunity is going to be coming. So if there's a deal, if there's a market that you want to take a look at, we can run the report, sort of figure out what loans are coming due in your market. Feel free to send me an email and we can do that. All right. So what's causing all this distress? Obviously we don't see the front end of this curve, but, basically was at zero, the federal funds rate, let's say COVID 2020, 21, and then stayed flat. And in 22 just went up like a rocket ship and, started at zero. Now it's at 550. So SOFR is at 550. If your spread on majority of your bridge loans and floating rate loans are anywhere from 3% to 4%, you're at 9% now, right? So you're at 9.5% if you don't have an interest rate cap. So an interest rate cap is almost a requirement now. And so majority of these deals are sort of stuck if you don't have an interest rate cap. The Fed is expected to bring down the rate slowly. This is the prediction by, end of 24, you're going to be at 4%. So you really don't have, I think people are looking at this and saying, if I can't survive past the next year, it's probably time to go in terms of selling. And so a lot of people are coming to market early, trying to avoid just sort of a flood of properties, because a majority of the deals, like when we look back at 21, majority of these deals were done as 3-year bridge loans. And so these people are going early in this case. And so a lot more people might be coming behind them. All right. So if you're on floating rate, this is what really drives your interest rate, right? So SOFR plus the spread on all your bridge loans, on all your floating Fannie and Freddie. But then 10-year Treasury is what drives fixed rate Fannie Freddie. And this thing it's been sort of quiet over the summer, really been sitting around 375 for most of the summer. Had a little bit of a spike here at the beginning of July, but it went on another run. And so at the beginning of August, it went on another run. The US government said that they were going to bring out more treasuries and sell more treasuries, which means more supply. And so it has popped up. It jumped up to like 415, 420. It's a little bit back down today. So 410 or so today. And so, when you're thinking about your all-in rate on fixed rate, you're about 200 basis points over. So 175 to 200 over typically. So you're around 6% today on a fixed rate. So one of the guys that I like to listen to is Walker & Dunlop. They are a Fannie Freddie lender, and they pretty much focus in on debt. And a lot of their call for second quarter was that they're hoping this is the low point of transaction volume, because the last 12 months have been pretty tough. They're basically seeing their quarter over quarter volume go up, but then their year over years are just hideous, right? So 22 numbers versus this year's numbers are hideous. It's down probably 50 to 70% across the board. But they're seeing a pickup sort of quarter over quarter, which is good. Fannie and Freddie. So they said that Fannie and Freddie have only deployed 30% of their 150 billion. So 44 billion of their 150 so far this year. And that's really a function of just there's not a lot of transactions, not a lot of acquisitions going on. And then a lot of these deals just can't get refinanced to Fannie and Freddie because of where the rates are. And they're hoping that the Q3 sales pipeline is picking up like we saw in my inbox from the beginning. There's a lot more broker activity. And, long-term rates is really determining the size, like we said before. And then, right now, agencies are so this was a key point that I think a lot of people who are existing owners should take, should sort of read between the lines on this one. So it says agencies are very, very focused on making sure the standard of quality at the apartments is safe, affordable, and maintained asset. And so what that means when you read between the lines is Fannie Mae is driving by your property today, next month, the month after that, and they are looking for things that they can see visually from the exterior in terms of issues at that property. So I want to make sure that everybody who has a Fannie Freddie loan, that they're keeping up their asset, because if you get on the list with Fannie and Freddie, whether it's A-check or any of these sort of bad boy lists, then it's going to be very hard for you to get off of it and very hard for you to do agency lending in the future. And so this was interesting. He also talked about where deals were happening. And he said, when financing was sort of 475 to 525, so that's with like a 325 to 350 10-year treasury, borrowers were okay taking that bet and going with a little bit of negative leverage, right? So they were essentially locking at 5% and their cap rate was 475 in that range. And so that was interesting because it's run a lot more since then. People are closer to 575 to 6 now. So that extra 50 basis points, I'm not sure people are willing to go quite yet, right? So in terms of timing, obviously most people want positive leverage versus negative leverage on these deals. All right, so Arbor is another Fannie Freddie lender, public company. They were a little bit more particular on the timing of this market right now. So they're thinking right now is the bottom. And the next couple quarters are going to definitely be the most challenging part of the cycle. They're already seeing delinquencies increase on their loans. They had two properties in Houston, another one in Atlanta that they put non-performing, which is basically like they're not paying us. And so they're probably going to have to work through those. And, they're thinking most of these downturns last about 18 to 24 months. They've been in it for 5 quarters. So they're thinking another 2 to 3 quarters left. And this is going to be the most difficult time. So it's definitely going to be choppy out there, to use the surfing analogy, but you're going to have to get through some of this. And, when they not only have the Fannie Freddie business, but they also have the bridge business. And so a lot of their bridge business is going to be coming in probably that second half of 24, which is really going to be new acquisitions at reset pricing coming in and buying a lot of these deals that might be distressed. And so the distress is going to be deals that can't qualify for Fannie and Freddie. So when we looked at that deal that was being bought essentially for the loan amount, that deal, the occupancy is like 75%. So it can't qualify for Fannie and Freddie. So someone's going to have to come in, do a bridge loan, and sort of reset that deal. All right. Marcus & Millichap, they are the largest broker really in the nation. They do a ton of multifamily. They were down about 50%, 50 to 60%. And you can see just from these trends, I mean, this is only half the year, but it's fallen off a cliff really from 22 to 23. And then, most people, you might be 2000, I guess if you double this up, you might be around 2012, 2013 volumes across all of commercial real estate. And it might be even more dramatic for multifamily in terms of these spikes. But in terms of, I thought this was interesting. They talked about who's buying in today's market. It really is private investors, right? So the institutional guys, the guys with these huge funds being raised, they have not redeployed back into the market. So whether they're having issues with redemptions, whether they're just more hesitant, the private investors are definitely picking up a lot of slack. And so they're close to 61% of the market right now. Okay, Camden, they are, I think they have 60,000 units across the Sun Belt. Their occupancy across the board has slipped a little bit. So it's gone from 97% down to closer to 95%. And then their new leases are about 3% or 2%, renewals about 6%. So blended about 4% across the board. And so this was, we see it on T12s nowadays, but just to have someone reiterate the expense burden that people are having. Property taxes are about, this I think this is a little bit low. I mean, maybe in Texas I'm jaded, but taxes up 4.5%, repairs and maintenance up 8.5%, insurance 37.5%. And so it's very hard if all your expenses are going up by this amount to just use 3% on those expense assumptions. So adjust your underwriting accordingly. And Camden, they're seeing a 70% decline year over year in transaction volume, and a lot of things that they do in terms of most of their stuff is A minus, and they were asking tenants like, okay, you're moving out, why are you moving out? And most of the time, about 10% or 11% last quarter said, oh yeah, I'm moving out to buy a house. And then in July, it dropped to 9.8%, which is the lowest since the great financial crisis. So that chart of it is hard to go out and buy a house right now is playing out for a lot of these tenants. And so a lot of the people, yes, there is a lot of new Class A coming online, but in that A minus space, B plus space, those people really aren't going to be moving to houses, and that rental supply is going to be pretty constrained, right? There's going to be a lot of stuff coming in on the top half of the Class A side, but sort of that middle B plus, A minus, I don't think there's going to be a lot. And then Camden also develops a lot of properties, and construction costs, they're saying, essentially been flat. Land pricing is down, so 20-30%, especially if that person's got to sell, but they don't necessarily have to sell with land, right? But then the interest rates have gone up so much, and then the rents have been essentially flat or lower, 3-4%. That's hard to pencil a lot of development. So they're thinking that a lot of deals are not going to pencil, and the next couple of years, the starts are going to go down, and 25, 26 is going to be incrementally a lot better, right? So they're thinking rental rise in 25 and 26 as just part of the cycle, right? So, let's call 21 the peak. And then if you're heading down this line, maybe, per Arbor, we're sort of in this section down here. Nobody knows, there might be a little bit more room to run. But if you're in this section now, the reason I chose this chart was that even though this was the peak in 21, this peak in, let's say, 26, 27 is going to be higher than the 21 peak. But you've got to make it through this section, right? So this might be the next 2-3 quarters, and then get through that and then come out the other side of it. All right. So I guess, CRE Daily is a newsletter that published NightVest's sort of quarterly update. So I'm not sure how they got it, but they published it. So I figured it was public knowledge. So they own 97 properties, 34,000 units across, the major Sunbelt areas. And their properties are about 93% occupied, 5%. So it's very close to Camden. The lease trade outs are positive, but look at this increase in insurance, 60% premium increase on insurance. And that was because you're having to use a higher dollar per square foot, and the values of these properties have gone up. And then taxes up 27%. And then it was interesting. They talked about institutional partners being okay with floating rate financing, and in private sort of family office, those guys want a fixed rate. And so a lot of institutional guys, I mean, they're smart in terms of having capital to deploy, and they can sort of pay off these loans. Whereas a lot of these private syndications, they sort of raise money deal by deal at a time. And so if you go back to these investors and say, hey, I know we did this floating rate loan, and we need another $2, $3, $4 million for the interest rate cap, they just don't get that. And they're just not in the business day in and day out. And so they just prefer fixed rate financing. And they made the note that Fannie and Freddie, they did a lot of floating rate business, or Freddie Mac did a lot of floating rate business, and they are not modifying their loan docs to say, okay, you don't have to escrow for as much in terms of rate caps. So no modifications on that point. And, a lot of NightVest's portfolio is A class stuff, and their average rent is about 1,600, and the mortgage on a $400,000 house or $400,000 mortgage is about 2,600. So they think that gap with fixed rates being 7% on single family, that's too big of a gap. On top of not only making the mortgage payment, the taxes, the maintenance, insurance, and then the down payment as well. So I think a lot more people are going to be sticking around on the A class side. They're saying same thing on developments. And then, they had a prediction on cap rates. So the cap rates they think are still going to keep going up for a little bit, but in about 2 years, they will be lower than they are today. And across the board, all floating rate loans, no distributions, fixed rate loans, the distributions have continued. So, if you hear it from one spot, it's one thing, but as you start going across, 60,000 units of Camden, the 30,000 units of NightVest, you start seeing themes across the board of all these top investors. And obviously, it's very hard to be a NightVest, a Camden, and really grow the portfolio to that size. But, you can make bets similar to these guys at a syndication level, at an individual level. That's really my background. Spent some time at GE Capital for 10 years as an underwriter. And then since 2015 have been focused in on originating multifamily loans across all over the nation, but really focused in on Texas across the 4 major markets. And so, all right, so that was really an overview of what we're seeing on the brokerage side, what we're seeing at the public level, at the private level, for investors, for brokers. And let's talk about, so usually we show this chart. I would say, Freddie Mac SBL has moved up in terms of rate, 6.5 to 7. Freddie and Fannie probably 575 to 625, just with that raise in the 10-year Treasury right now. And then, but we're going to dive in sort of product by product, loan by loan here today. So, bank loans, banks have been hit pretty hard by, the SVB, all of, just the turmoil in the banking industry, and just with these deposits that have gone up significantly. And so, they are really focused on existing relationships. So if you have deposits with them, then they're more likely to bank you. We're seeing bank loans still get done, mostly sort of 1 to 5 million in that range. They're faster to close, let's say 30-day close. And then you a lot of times don't have a prepayment on exit, but it is still difficult to get development loans done right now on the banking side. And so that is what people are counting on sort of for a hole in the supply in 25, 26, 27. Freddie Mac SBL, they track 10-year Treasury pretty closely. They have still been pretty active. They are pushing on affordability. So if your deal is affordable, you're probably 6.5 to 7. If it's not affordable, you're probably 7.5%. But this is still a viable source for a lot of people out there on the smaller deals. Freddie Mac conventional, they're short like Fannie, but a lot of acquisitions still getting done with Freddie Mac. There a lot of times you're getting 5 to 7, 10 years IO on Freddie Mac, but then they're starting to, if it is affordable, get into that 35-year AM selectively. So if you're able to get the 35-year AM, fix the rate 575 to 6, a lot of people are still buying with this product type. And in Fannie Mae, they had a 35-year AM program sort of expired. So if you got in well over the summer, then it's still held. But they're getting a little bit more aggressive. So they're doing a lot more full-term IO, especially 5, 7, 10-year money. But pricing is pretty similar to Freddie Mac, so 575 to 625 on Fannie. Non-recourse, we saw that deal that was being bought sort of with 75% occupancy. People are still using bridge loans, but I would say lower leverage, 60, 65%. But then, you're rolling 100% of the rehab into it, and they're buying tighter strikes. So tighter strikes being, they're capping SOFR, which is at 5%, 5.5% now. They're capping SOFR at anywhere from, let's say 2% or 2.5%, just to keep the interest rate in a reasonable around 5 to 6% range on those deals. So here's some of the deals that Old Capital has closed this year. Last year we did about 1.2 billion. This year we're down, probably about half of that, like most other shops across the board, just with the number of transactions. And the shift has really been from non-recourse bridge over to Fannie and Freddie. So if you look at a lot of these deals, they were done Freddie Mac, Fannie Mae, a couple recourse bank loans across the board. So, but definitely reach out to us if you have any questions on any deals. We are here through all these cycles. So you can look at 10-year treasury. You can see that this is what's causing a lot of distress right now is this, this 10-year treasury being close to 4% right now. I started right here sort of in 2015 and rates were always sort of around 4 to 5%. And it just sort of sat there, sort of ticked up a little bit here. But now, we're getting close to 6% now. So through all these cycles, we help you understand what's going on in the market, whether it's our podcast, our conference, speaker series, lunch and learns. We're a second set of eyes for you on these properties and throughout the loan process. So our big show coming up October 4th and 5th is our conference. And so if you have not registered for that, go to oldcapitalconference.com and you can find out all the details there. We usually have 400 to 500 investors, brokers, lenders, everybody, property managers, all there. And so if you haven't registered for that, definitely check it out. And if you like this channel, definitely subscribe, like, comment, show me where you've been surfing or where you went this summer. I'd love to hear more about how you guys have taken it easy the past couple months, and now it's time to get back at it. Kids are getting back into school. So if you need help with looking at a deal, send me the T12 rent roll OM whisper price and I can get it term sheet. And then if you're looking at investing in a deal and you want just a couple thoughts, feel free to send it over to me. Usually we'll set up some time to go through your personal financial statement and talk about buying, selling, refinancing your next multifamily deal. And if you're interested in joining Old Capital, I think this is going to be sort of the beginning of the new cycle. Send me an email with your resume and we can talk from there. But thanks a lot for joining, and I'll see you guys next month.